Millions of households are steadying their paper receipts, tracking a steady climb in the cost of basic groceries. That pressure continues when those same families pull up to the pump. High energy and transportation costs are steadily eroding the purchasing power of an average paycheck. We are looking at an economy caught in a standoff. Production and spending indicate growth, but the daily cost of living points toward a painful slowdown. Resolving this standoff comes down to the decisions made inside one institution. The policymakers at the Federal Reserve hold the levers of the U.S. financial system. How they choose to manage these rising costs will dictate whether everyday families find relief or face a harsher economic climate. This chart tracks consumer prices. After the initial spike, the line doesn't drop to its historical baseline, creating a stubborn plateau. Isolating the data, the anchor weights keeping numbers high are energy and housing. And when the prices of absolute necessities refuse to fall, the plateau functions as a direct, inescapable tax on the middle class. Domestic demand is only half the equation. These costs are heavily tethered to global supply chains, where international shipping friction keeps import prices artificially high. The Federal Reserve has to drag those prices down. Doing so without freezing the job market or triggering a recession is the delicate, high-stakes tightrope they are walking. Inside this room, policymaker tool to combat rising prices, the federal interest rate. The federal rate acts as a master lever. Pushing it higher dictates the base cost of borrowing money. As commercial banks pay more to borrow, they instantly pass that premium onto consumers and businesses. The immediate result is that carrying a balance or swiping a credit card for daily expenses carries a much heavier financial penalty. Corporate borrowing gets equally expensive. Companies scale back expansion plans and pause hiring, which is why market investors closely track these rate decisions to forecast stock performance. This restriction is not an accident. Making money expensive to borrow is designed to deliberately cool down consumer demand and business spending. The drop in demand eventually starves inflation, but the resulting shockwaves hit specific, credit-dependent industries with severe force. No sector relies more heavily on affordable debt than American real estate. On the supply side, home builders are stalling new projects. The loans required to purchase land and secure materials have simply become too expensive to justify the risk. Demand is being crushed simultaneously. With mortgage rates elevated, the monthly carrying cost of an average home has priced massive portions of the population out of the market entirely. This graph illustrates the collision. The top line shows construction costs climbing, while the bottom line tracks declining purchasing power. The space between them creates a deadlock zone. Sellers cannot afford to build, buyers cannot afford loans, transactions stop. Until the rates drop or incomes rise, securing property remains statistically out of reach for a generation of families. Despite the freeze in real estate and the high cost of debt, the broader economy has not collapsed under the pressure. Core sectors are operating with surprising durability. Consumer spending has slowed, but businesses are still generating output and maintaining steady payrolls. This resilience creates a paradox. A healthy job market allows consumers to keep spending, which inadvertently keeps prices high and forces the Fed to maintain elevated interest rates. For the individual consumer, the reality is clear. Taking out new loans or financing large purchases will remain highly expensive for the foreseeable future. The housing market will stay gridlocked until the central tension between federal rates and consumer inflation finally breaks. Navigating this environment requires precision. Minimizing debt, maintaining strict household budgets, and tracking market movements are necessary defensive measures. The coming months will determine if the U.S. economy can land smoothly or if it tips into a recession. In either scenario, careful financial literacy remains the strongest protection an American family can hold.